Hi folks, welcome back to our Forex trading course. Today we are going to do Forex Advanced episode 2, and it's a continuation of the fundamental analysis. In the previous class, we looked at various fundamentals, the interest rates, inflation, and employment outlook. And in today's class, we are going to do a continuation of fundamentals, and we are going to look at the monetary policy. We are going to look at balance of payments, economic growth expectations, capital flow, and political factors. Like I said, these are very key fundamentals that really move the market. And the reason why you need to understand them so that you can be able to position yourself accordingly. So when we talk about the monetary policy, basically, you need to understand that monetary policies entails the factors or the measures that are taken in order to achieve certain economic goals or mandates. So national governments and their corresponding central banks authority formulate these monetary policies in order to achieve certain goals economically. Okay, so monetary policy trickles down to promoting and maintaining price stability and economic growth. That is the purpose of the monetary policy. And to achieve these goals, the central bank or the national government use monetary policy mainly to control the interest rates, the money supply, and the reverse requirements of our banks. Okay, so basically, those are the key things that the monetary policies are formulated to control. So when we talk about the interest rates, when the interest rates are high, this means that there is a high inflation. Okay, so basically how they're interconnected. When there is high inflation, the interest rates are high, or the central banks increases the interest rates in order to lower inflation. Okay, so once it makes those formulations or decisions, these are what you're calling monetary policy. Okay, and again, as you have seen with the rise in inflation, we said when the inflation is high, the central bank will tend to increase the interest rates so as to lower the inflation. And once it increases the interest rates, it means that there is supply of money. Okay, it means that there is supply of money because once interest rates are increased, it means that uh, the inflation rate goes down, and therefore it trickles down to ensure consumer spending, meaning that there will be supply of money. The other factor, fundamental key factor, is the balance of payment. And when we talk about the balance of payment, you need to understand that a country's current account reflects balance of trade and earnings on foreign investments. So when you need to understand that each and every country has a current account, and this current account is basically used for balance of trade and earnings on foreign investment. Therefore, balance of trade measures the ratio of exports, imports for a given economy. And how we interpret this is that when exports are greater than imports, we say that there is trade surplus. That is a positive trade balance. When we have a positive trade balance, it means that as a country, whatever you're exporting is greater than what you're importing. And this means that the economy is vibrant or the economy is strong. And if the economy is strong, it trickles down to the currency of that particular country, meaning that the currency is strong. Therefore, if the currency is strong, it means that the currency is in demand. And therefore, that particular currency of that country, let's say, for instance, it is USD, it is USD, okay, United States of America. So if the exports of United States of America are more than the imports, then it means that the country has trade surplus. That is a positive trade balance. And therefore, its economy is thriving well because they can be able to service themselves economically because they have a surplus, a positive trade balance. And therefore, this means that the USD will be strong. Therefore, if USD is strong, any pair that has USD as base currency will sell, and any pair that has USD as good currency will buy. Okay. The other scenario is when imports are less than exports, or when imports, the other scenario is when imports are greater than exports. So when imports are greater than exports, it means that whatever a particular country is importing is greater than what it is exporting. Remember, imports, they are an expense. Exports, they are an income. Therefore, when expenses are more than income, therefore, we will have a trade balance, a trade deficit. Therefore, when the imports are greater than the export, we shall have a trade deficit. That is a negative trade balance. And this will trickle down to the currency of that particular nation, whereby that currency will weaken. Okay, the economy will be not performing well because it cannot support itself, and therefore you find that the currency will be affected. It will become a weak currency. Even investors will not want to invest in a country that has a weak currency. They want to invest in a country that has a strong currency so that as the currency increases in value, they make profits. Okay. So as an example, let's take, for instance, UK. UK, they use GBP. So if UK imports are greater than the exports, it means that the GBP will weaken. So if GBP weakens, any pair that has GBP as base currency will sell. And any pair that has GBP as good currency will buy. Okay, so that's how we apply it to the trading perspective. You need to note that a negative trade balance causes a country's currency to weaken as they spend more on importing products than they earn through sale of export, just like I explained. Conversely, a positive trade balance of payment tends to be favorable to the country's currency as it earns more foreign money. Let's go to the next, economic growth expectation. And economic growth expectation relates to the economic outlook as held by consumers, businesses, and the governments. It is easy to understand that when consumers perceive a strong economy, they feel happy, they feel happy and save as they spend money. So companies with money will spend it all as it creates some healthy tax revenues for the government. They jump on board and also start spending money. Now everyone is spending, and this tends to have a positive effect on the economy. So if the economy is performing well, or there is a positive effect on the economy, then it means that the currency of that particular nation will strengthen. It will be in demand. People will want to invest in that particular nation. Okay. Weak economies are usually accompanied by consumers who aren't spending, businesses which aren't making any money and aren't spending. So the government is the only one still spending. And therefore, for such a scenario, to meet the needs of a growing population, an economy must expand. However, if growth occurs too rapidly, prices increases will outpace wages advances, so that even if workers earn more on average, their actual buying power decreases. Okay, so if there is again that rapid growth, all of a sudden there is a rapid growth, it means that the price increases will outpace the wage advances. And this means that the buying power decreases, okay? So whatever you could do with $1,000, it's decreased. Okay, the $1,000 that you have, maybe right now you could buy a full basket of shopping. Okay, then it means that if there is that uh, rapid growth, maybe in 1 month's time, it means that the purchasing power of the $1,000 that you had will decrease. Therefore, maybe probably that time you'll not be able to shop a full basket, but you'll be able to shop a half a basket because the purchasing power has decreased. Therefore, if a country releases higher than expected GDP numbers, it means it has produced more goods and services and will export more. Its currency will appreciate. Okay. So again, when you're talking about economic growth expectation, this is where the gross domestic product comes in. Okay. So in the Forex factory calendar, you'll see the GDP news. So once you see this GDP news, you'll be able to understand that if if a country has produced more goods and services and will export more, then this means that the currency will appreciate. If the country has more goods or it has more goods, it means that there is even maybe probably surplus. Therefore, it will be able to export more. And exporting, we said, is a source of income. And therefore, if it exports more, the more it exports, the more the more stronger the currency of that economy is. Therefore, in the Forex factory, if you happen to see that maybe they are projecting that GDP will increase, GDP numbers will increase comparing from the previous and the forecasted. Therefore, you want to predict or you want to have in mind that the currency of that particular country will increase in value. Okay. And if that currency will increase in value, you need to note that if that currency is a base currency, let's say, for instance, maybe USD. If USD is going to increase in value because GDP numbers have increased, then it means that USD will strengthen, okay? And if USD is strong, then it means any pairs that have USD as base currency will buy, and any pairs that have USD as good currency will sell, okay? That's how you interpret it and relate it to the trading perspective. Then we look at what we call the capital flows. And when we talk about capital flows, this is the measure of the amount of money flowing into and out of a country or the economy because of capital investments, purchasing, and selling. Therefore, the important thing that you want to keep track of is capital flow balance, which can be positive and or negative. When a country has a positive capital flow balance, foreign investments coming into the country are greater than investment heading out of the country. This means that income coming out of the country is greater than expenses going out of the country, okay, in a layman's scenario. A negative capital flow balance is the direct opposite. Therefore, which means that investment leaving the country for some foreign destinations are greater than investments coming into the country, okay? And with more investment coming into a country, demand increases for that country currency, as foreign investors have to sell their currency in order to buy the local currency. This demand causes the currency to increase in value. If supply is high for a currency or demand is weak, definitely when supply is high, it means demand is weak. The currency tends to lose value. And if a country has a growing domestic financial market, this becomes even better for that economy, okay? The other factor that we look at is the political factors. And these political factors, you find that they are not listed in the Forex factory calendar, okay? Because these are news that are unpredicted. Some of them are unpredicted. For instance, war can erupt from anywhere in a particular country. like what we had in Russia and Ukraine. This was not listed in the Forex factory calendar. No one knew that such kind of a war could erupt. And therefore, these are unforeseen events, okay? And you find that they really affect the market as well, especially the currency of the countries that are in war. They tend to weaken. For instance, the Russian currency weakens, the Ukraine currency weakens. And this will have an effect in the market because you find that Russia is a producer of oil, for instance, okay? Or they produce some commodities that basically almost other countries in the world rely on. So if there is war, it means that the production is low. Therefore, it will also affect even other economies. And when other economies are affected, it means that their currency is also affected. Another example of political factor is, for instance, the general election of a particular country. Let's say whatever happened in the United States, the general election in the United States, you find that during that time, they really affected the economy of the United States and the currency was affected as well. Remember, in our case, you're interested with the currency because this is what we are going to trade in the Forex market. The issue about Brexit as well, this was political, and you find that it really affected the GBP as well. Also, when the UK Prime Minister resigned, again, this was temporary news, but they really affected the market at that time when the announcement was made. Therefore, in conclusion, I want to say this: most of the most of the key fundamental factors, you'll find them listed in the Forex Factory calendar. I showed you the Forex Factory calendar in the previous class and how to check the news, and therefore you can be able to plan ahead for them. However, there are some other news or other key fundamental factors, such as political factors, that will not be listed. And the reason why, now in our next class, we're going to do about risk management. The reason why you ought to be properly leveraged, or you need to have proper risk management, because there is uncertainty in the market. Anything can happen as long as you are trading. Anything is bound to happen. And if anything is bound to happen, therefore it means that you need to have proper risk management. And therefore, in our next class, we are going to do risk management, so that now that you have a lot of information, that you can go into the Forex market and trade and start making money, you need also now to be acquainted with the risk management principles that we apply in order for you to ensure that you remain longer in the market, such that you don't deposit your money today and tomorrow the account is blown, okay, because of poor risk management. Therefore, ensure you subscribe, like, and share so that you don't miss my next class. Thank you so much.